This is not normal price action. In off-hours trading, key crude benchmarks exhibited abrupt repricing that cannot be dismissed as routine volatility. Heavy crude benchmarks, particularly those tied to non-OPEC heavy barrels, diverged sharply from lighter grades under thin liquidity conditions, signaling acute structural stress in the energy complex. This is not a routine blip. This reflects an urgent rebalancing of risk, liquidity, and supply confidence across global oil and energy markets. Before we proceed, note, this commentary is analytical. It is not financial advice, not investment guidance, and not a sales pitch. Today, the market is signaling a deeper shock, one rooted in geopolitical disruption and market structure stress that has only begun to surface, the abnormal price signal. The recent price action is not routine volatility. We witnessed heavy crude differentials widen substantially while front-month futures experienced dislocations inconsistent with historical patterns of seasonal demand shifts. These moves occurred largely outside of regular U.S. trading hours when liquidity is thin and prices are most sensitive to singular catalysts. This is not normal price action because it did not occur in the context of a clear supply-demand mismatch in fundamentals alone. Instead, the price signals reflect liquidity stress, delivery risk, and confidence repricing. Heavy crude, such as the grades Venezuela produces, has repriced sharply, not merely on volume expectations, but on uncertainty about export viability, sanctions regimes, and political control of barrels previously off limits. The market is testing the confidence of participants who thought Venezuelan oil was effectively sidelined. It is now being priced as a live factor. Moreover, this price move occurred during a period of thin liquidity and geopolitical headlines, amplifying the signal beyond what traditional fundamentals would justify. That is precisely what warrants urgency in interpreting the event. Geopolitical catalyst. At the core of this pricing anomaly is a dramatic geopolitical shift. The United States has significantly altered its posture toward Venezuela's oil industry following late 2025 sanctions, naval blockade operations against sanctioned tankers, and a reported military intervention culminating in the removal of Nicolas Maduro from power. The U.S. now asserts control over Venezuelan oil exports and is preparing to relax sanctions with a general license designed to reintegrate Venezuelan barrels into global markets. This is a geopolitical inflection point. For years, Venezuela's oil was constrained by sanctions, embargoes, and underinvestment. Today, those constraints are being renegotiated in real time. Major trading houses have obtained U.S. export licenses and begun preparing cargoes for global delivery, while producers reassess their export strategies in the face of new political risk and legal uncertainty. The geopolitical volatility goes beyond traditional sanction dynamics. Global fragmentation, shifting alliances, and competing energy strategies by major powers, including China's recalibration of Venezuelan imports, are reallocating capital flows into perceived safe haven energy assets, even as political risk premiums soar. This is not simply geopolitics in the abstract, it is realignment of supply routes, contractual frames, and strategic control over tens of millions of barrels of crude that were previously sidelined, now potentially flowing into refineries across the United States and Europe. U.S. economic vulnerability. The abnormal price action holds material implications for the U.S. economy. U.S. refiners along the Gulf Coast are heavy processors, engineered to take in high sulfur, heavy crude grades like those from Venezuela. A resumption of Venezuelan heavy oil into these systems could reduce imports of other heavy grades and alter the feedstock mix. That shift in feedstock dynamics affects margins, inventory valuations, and the relationship between crude benchmarks and refined product pricing. Lower-cost heavy crude can compress margins for refiners configured to process lighter crudes, which in turn can ripple into diesel, kerosene, and fuel oil dynamics. Price dislocations in crude markets also feed into inflationary pressures. Dislocations outside of normal trading hours carry through into spot markets for fuel and industrial inputs, which ultimately affect transportation and manufacturing costs. Disrupted confidence in stable energy pricing feeds into the broader macro narrative of inflation persistence, precisely at a time when the U.S. Federal Reserve and monetary authorities are scrutinizing underlying inflation signals. Supply chain fragility is further exposed. Venezuela has long struggled with diluent shortages necessary to blend its heavy crude to exportable grades. These structural inadequacies underscore how vulnerable the global energy supply chain remains to political operational breakdowns and how quickly that fragility can spill into broader commodity markets. Confidence across markets is being tested, not for speculative reasons, but because fundamental energy flows, critical to industrial output and transportation, are being repriced amid shifting geopolitical control. Market mechanics and structural stress. To understand the depth of this event, we must examine market mechanics. There is a widening chasm between paper markets, futures contracts, and derivatives trading financial exposures, and the physical reality of oil flows. Futures markets can reprice risk almost instantaneously, but physical delivery requires infrastructure, logistics, legal certainty, and sanctioned routes. When geopolitical events outpace physical capacity or regulatory permission, basis risk emerges, meaning the price between physical barrels and futures contracts diverges sharply. We saw exactly that dynamic when heavy crude benchmarks diverged from broader crude indices. Liquidity in heavy crude contracts is thinner than for Brent or WTI, and off-hours trading exacerbated moves that might otherwise have been absorbed during higher liquidity periods. Additionally, structural issues such as backwardation, where futures prices for near delivery exceed distant delivery prices, indicate market stress around immediate availability and delivery risk. Repeated anomalies of this sort suggest deep structural stress rather than isolated volatility. This is not ephemeral. It reflects a market grappling with delivery risk, legal ambiguity, and a reconfiguration of who controls global barrels. The bear case and risk factors. It is critical to maintain balance. Volatility cuts both ways. While the narrative of Venezuelan oil returning to the market could imply downward pressure on oil prices, several risk factors could flip this scenario. First, the logistical reality. Decades of underinvestment have degraded Venezuela's oil infrastructure. Output remains a fraction of its historical peak, and even aggressive investment proposals are unlikely to restore production rapidly. Second, sanctions and export licenses can be expanded or revoked unilaterally, introducing policy risk that can trigger abrupt volatility. The risk of geopolitical backpedaling is high when national strategies shift or domestic political pressure rises. Third, historical examples remind us that periods of sudden repricing often revert. Temporary oversupply expectations have previously reversed when infrastructure or political constraints reassert themselves. Forced selling in derivatives markets during liquidity droughts can exacerbate downturns before fundamentals adjust. Market interventions, and whether from central banks, strategic petroleum reserves, or regulatory actions, can rapidly alter sentiment and repricing pressures. Markets that anticipate intervention often price that anticipation in advance, leading to short-lived divergences that correct sharply. Strategic, reframe, and long-term implications. This event should be reframed not as a prediction, but as a signal. It is an early warning. A tension between price formation and real-world supply, between geopolitical ambition and operational reality. The structural pressures revealed here, geopolitical fragmentation, fragile supply chains, legal regulatory uncertainty, and fundamental infrastructure decay, will not disappear quickly. They may remain latent until the next trigger. This divergence between paper pricing and real-world pressure is precisely what markets discount ahead of fundamentals catching up. What we see now is a reconfiguration of risk, confidence, and strategic control in global energy markets. This is not a certainty of future price direction. It is a real-time repricing of energy risk that impacts capital markets, macro stability, and industrial planning. This is your capital, your future, your responsibility. The abnormal price signal deserves to be treated as a warning, not a curiosity. What occurred in the crude market was not a standard repricing driven by inventory data, refinery runs, or routine macro releases. The move emerged during periods of thin liquidity, largely outside core U.S. trading hours, when market depth is weakest and price discovery is most fragile. That timing matters. When significant price dislocations occur under those conditions, it is rarely because participants are expressing long-term conviction. It is because stress is being exposed. In normal conditions, crude oil markets absorb information gradually. Even geopolitical headlines typically bleed into prices over several sessions as traders assess credibility, scope, and follow-through. What we observed instead was an abrupt widening of heavy crude differentials and a sharp repricing in contracts tied to non-standard barrels. This was not a broad-based rally or sell-off. It was targeted, uneven, and highly specific. That kind of move points away from speculation and towards structural strain. Heavy crude is not interchangeable with light crude. It requires specialized refining capacity, specific blending components, and reliable logistics. When heavy crude prices begin to move aggressively relative to benchmarks like Brent or WTI, the market is signaling concern about availability, delivery confidence, or legal access. Those concerns are amplified when the move occurs during illiquid hours, because it suggests that even a small imbalance in bids and offers is enough to force prices higher or lower. That is not a sign of a healthy market. It is a sign of brittleness. The speed of the move is also instructive. Sudden repricing indicates that participants were positioned for stability that no longer exists. When a market is properly hedged and liquidity is robust, shocks are absorbed through volume. When liquidity is thin and positioning is crowded, shocks express themselves through price. This is what we saw. The market did not debate the implications. It jumped to reprice risk immediately. There's also the issue of asymmetry. The price action was not symmetrical across maturities or regions. Near-term contracts reacted more sharply than deferred ones, and physical linked pricing moved more violently than purely financial instruments. That pattern reflects concern about immediate availability rather than long-term abundance. When the front end of the curve becomes unstable, it usually indicates uncertainty around delivery, regulation, or control of supply in the near term. This is precisely where geopolitical disruptions exert the most pressure. Importantly, this was not driven by a clear, measurable disruption such as a pipeline outage or a hurricane. There was no single operational failure that justified the magnitude or timing of the move. Instead, the catalyst was ambiguity. Ambiguity around who controls barrels, which contracts are valid, which exports are permitted, and which counterparties are exposed to regulatory or legal risk. Markets are comfortable with bad news. They are far less comfortable with unclear rules. This is why the move should not be dismissed as noise. Routine volatility tends to cluster around known events and resolve once uncertainty clears. Structural stress, by contrast, reveals itself through repeated anomalies. Off-hour spikes, widening basis spreads, inconsistent reactions across related instruments. These are not accidents. They are symptoms of a market that is struggling to reconcile paper pricing with physical reality. Another critical aspect is confidence. Energy markets are ultimately confidence markets. Participants must trust that contracts can be settled, that delivery can occur, and that political frameworks will not change arbitrarily. When confidence erodes, liquidity retreats. When liquidity retreats, prices gap. That feedback loop is exactly what abnormal price action reflects. It is not telling us where prices must go. It is telling us that the system is under strain. The urgency comes from the fact that these signals rarely appear in isolation. They tend to precede broader adjustments in market structure, whether through repricing of risk premiums, withdrawal of liquidity providers, or increased volatility across related assets. When energy markets destabilize at the margin, the effects propagate quickly into currencies, rates, and industrial inputs. In short, this price signal matters because it emerged under abnormal conditions, targeted a structurally sensitive segment of the market, and revealed fragility rather than exuberance. The market is not speculating, it is recalibrating trust. And when trust is recalibrated in the world's most important commodity market, the implications extend far beyond a single trading session. The geopolitical catalyst behind this move is not a single headline or policy announcement. It is the cumulative effect of years of fragmentation in the global energy order now colliding with an abrupt shift in control, legitimacy, and access to supply. Venezuela sits at the center of that collision. What the market is reacting to is not merely the return of barrels, but the uncertainty surrounding who controls them, under what authority, and for how long. For over a decade, Venezuelan oil existed in a gray zone. Sanctions, export bans, financial restrictions, and enforcement uncertainty pushed its crude out of formal markets and into opaque channels. That created a parallel system of shadow shipping, discounted pricing, and non-transparent counterparties. Markets adapted by treating Venezuelan supply as effectively unreliable. It was not fully counted, fully trusted, or fully integrated into forward expectations. That assumption is now being challenged. Recent geopolitical actions have altered the framework entirely. The United States has moved from indirect pressure to direct involvement, reshaping the political landscape and asserting influence over Venezuelan energy exports. Sanctions policy is no longer static. It is conditional, revocable, and explicitly tied to political outcomes. This introduces a new layer of uncertainty. Barrels that were previously excluded are now potentially available, but only under rules that can change quickly. Markets struggle with that kind of conditional supply. This is where geopolitical instability translates directly into price action. Energy markets can price scarcity. They can price abundance. What they cannot price easily is political discretion. When access to supply depends on shifting diplomatic calculations, legal interpretations, or enforcement priorities, risk premiums rise even if headline supply appears to increase. That paradox is central to the current dislocation. Global fragmentation intensifies this effect. The world is no longer operating under a unified energy order. Trade flows are increasingly politicized. Sanctions are used as strategic tools rather than temporary measures. Export controls and licensing regimes have become instruments of leverage. In that environment, energy assets are no longer neutral commodities. They are geopolitical instruments. Capital responds accordingly. We see this in the behavior of major state-linked buyers and trading houses. Some are cautious, delaying purchases despite theoretical access to Venezuelan crude. Others are positioning early, seeking advantage but demanding higher compensation for political risk. This divergence fragments liquidity. Instead of a deep, unified market, supply is segmented by jurisdiction, compliance risk, and diplomatic alignment. That fragmentation itself becomes a source of volatility. Resource nationalism further complicates the picture. Venezuela's leadership transition has not eliminated the underlying tension between sovereign control and foreign participation. Legislative reforms and production sharing proposals signal openness, but they coexist with a long history of contract revisions, expropriations, and retroactive policy shifts. Markets remember that history, they price it into every transaction. As a result, even positive developments carry a risk premium. This geopolitical backdrop drives capital reallocation. When energy supply becomes politically contingent, investors and institutions seek exposure that feels more defensible, more controllable, or more liquid. That can mean reallocating toward jurisdictions perceived as stable, toward physical assets rather than paper claims, or toward commodities that serve as geopolitical hedges. These flows are not speculative in nature. They are defensive. They reflect a reassessment of where political risk resides. Safe haven dynamics emerge not because participants expect immediate crisis, but because they recognize structural instability. Energy markets sit at the intersection of geopolitics, inflation, and national security. When that intersection becomes unstable, risk is repriced across the system. Oil is particularly sensitive because it underpins transportation, manufacturing, and military capability simultaneously. What is critical to understand is that this is not a temporary geopolitical flare-up. It reflects a broader trend towards strategic control of resources in a multipolar world. The Venezuelan case is simply the most visible expression at this moment. As global powers reassess supply chains and energy independence, markets must adapt to a world where access is negotiated, not assumed. The market reaction, therefore, is not about optimism or fear regarding Venezuelan production volumes. It is about governance, enforceability, and durability of access. When those variables are in flux, prices move abruptly, liquidity thins, and correlations break down. That is exactly what we are witnessing. This geopolitical catalyst matters because it transforms oil from a purely economic input into a political variable once again. And when politics reasserts itself in commodity pricing, markets do not move smoothly. They gap, they fragment, and they test the assumptions that underpin stability. The current price action is the market acknowledging that shift in real time. The significance of this move for the United States lies not in abstract macro theory, but in direct economic exposure. Energy is a foundational input across the U.S. economy, and disruptions or distortions in oil markets transmit quickly into inflation, industrial margins, and consumer behavior. The recent price action is a signal that those transmission channels are under stress again, at a moment when economic resilience is already being tested. One of the clearest implications is inflationary pressure. Even when headline crude prices appear stable, volatility and dislocations in specific grades affect downstream pricing. U.S. refiners, particularly along the Gulf Coast, rely heavily on predictable access to heavy crude blends. When the availability, legality, or pricing of those blends becomes uncertain, refiners adjust procurement strategies. Those adjustments carry costs. They show up in wider crack spreads, inventory inefficiencies, and ultimately in refined product prices. Inflation does not need a sustained oil spike to reassert itself. It only needs instability. This instability also exposes supply chain fragility. The United States optimized its refining and logistics infrastructure over decades under the assumption of stable global trade flows. Heavy crude imports from geopolitically complex regions were considered manageable risks within a rules-based system. That assumption is now under pressure. When a major source of heavy crude becomes subject to shifting political control and conditional access, the system loses redundancy. Flexibility declines. Any disruption, even temporary, becomes harder to absorb. The market response reflects this vulnerability. Price signals are not merely about supply volumes, but about confidence in continuity. When continuity is questioned, firms build buffers. They hold more inventory, diversify suppliers at higher cost, or accept less efficient inputs. All of those responses are inflationary. They represent a tax on efficiency imposed by uncertainty. Fiscal and monetary stress intersect here as well. The U.S. economy is carrying elevated debt levels, and fiscal policy remains expansionary by historical standards. Monetary policy, meanwhile, is constrained by the risk that renewed inflation could undermine credibility. Energy-driven price instability complicates that balancing act. It forces policymakers to weigh growth risks against inflation risks under conditions where external shocks are increasingly geopolitical rather than cyclical. This dynamic erodes confidence. Markets do not operate in isolation from expectations. When businesses and consumers perceive energy prices as unstable or politically influenced, behavior changes, capital expenditures are delayed, long-term contracts are renegotiated, consumers become more cautious. These are not dramatic reactions, but they accumulate. Over time, they dampen growth and amplify sensitivity to further shocks. There is also a strategic dimension. Energy security has reemerged as a national economic issue. Dependence on specific crude grades ties U.S. industrial output to foreign political outcomes. While diversification is possible, it is neither immediate nor costless. Retrofitting refineries, reconfiguring supply chains, and securing alternative sources take time and capital. During that transition, vulnerability remains. The current price action reflects awareness of that vulnerability. Markets are reassessing the assumption that the United States can smoothly substitute one source of supply for another without friction. That assumption held in a more integrated global system. It is less reliable in a fragmented one. Crucially, this is not a theoretical future risk. The effects are already visible in hedging behavior, inventory management, and regional pricing. When energy markets send signals under abnormal conditions, they often foreshadow broader economic adjustments. The U.S. economy, with its scale and complexity, feels those adjustments through multiple channels simultaneously. What the market is signaling is not imminent crisis, but reduced margin for error. When inflation risks, supply chain fragility, and fiscal constraints converge, even modest shocks can have outsized effects. Energy sits at the center of that convergence. The recent move is a reminder that economic stability is increasingly contingent on geopolitical stability, and that contingency carries a cost. In that sense, the price action is a reflection of declining confidence in the durability of the current equilibrium, not a collapse but a stress test. And the U.S. economy, deeply integrated into global energy flows, cannot avoid being part of that test.